Hey guys, welcome back to another video by Fully Informed Trade, or Fitrade for short. My name is Alex Cho, and today in this video I am going to review a stock that I really like. It's a value but yet growth stock that I just happen to happen to find, and by complete surprise. So I just want to go ahead and share this information with you all. So yeah, let's go ahead and get into the information. Alright, the stock that I'm really interested in is Concord Medical Services ADR. And it's basically a Chinese company that operates medical facilities. And it operates a network of radiotherapy and diagnostic imaging centers in China. And the company's network as of December 31, 2009, comprises 88 centers based in 57 hospitals, spanning 36 cities across 21 provinces and administrative regions in China. Obviously, there are many more hospitals than just 57 in the major areas, so there's still a lot of growth potential left. And remember, guys, medical technology and the demand for it will continue to grow as there's a huge growing population of the Chinese older population, and even the younger population. There's a population of around 1.4 billion people in China, and over time you're going to have to get those radiotherapy diagnostic imagery. So again, amongst 1.4 billion people, it's no surprise people have demand for radiotherapy imaging technology. Now, the financials are very, very favorable, and the gross margins are very good. 67% gross margins, 46% operating margin, pre-tax margin at 44%, and the net profit margin is 33%. So these guys are left with a net profit of around 33% on revenue. That is absolutely excellent. The company's financials for 2010 was $372 million in revenue, and their net income sat at around $129 million. Very good. However, there is one drawdown that I do notice. The cost of revenue did go up drastically, and the thing is that it's not really the cost of revenue, but the general administration expenses suddenly jumped up to $87 million. So it quite literally doubled. Even though the net income hasn't doubled, that does get me a little cautious. But other than that, that's the only blemish that I see on their financials. So there is some risk. There is some potential risk that the CEOs or whatever are paying themselves more than what they deserve, and they're adding on added expenses that they shouldn't. Now, aside from that risk, however, there is some great potential. Currently, the company is priced at around a 0.66 price to earnings growth. PE ratio sits at around 14.32. The PE ratio is below the healthcare facilities industry average. It also means that investors are unwilling to pay a premium for the stock. So, and additionally, during the last year, earnings growth has outpaced its historical 5-year growth rate. So basically right now we have a great 1-year earnings per share growth rate, but analysts anticipate a 20% long-term growth rate. And if I use the formula that I basically got from the Intelligent Investor, 129 million plus 8.5 times twice the growth rate, so 8.5 plus 40, 48.50. Growth rate is 20%, double the growth rate to around 40, plus the 8.5, 48.5, 48.5 times 129 million in current net income gives you a $6.5 billion market valuation 5 to 7 years down the road. Currently, the market valuation sits at around 272 million, implying that we can anticipate the stock to have around 2,200% appreciation, or 22 times the value of its current price. So assuming that, we should see the stock somewhere around $100 to around $120 per share in the near-term future. However, with a 20 price to earnings ratio, after it achieves, over a course of 6 years, the net income expectation sits at around, give or take, 385 million. So again, that's not exactly a huge amount, but still pretty decent. I'm going to go ahead and check those figures again just to make sure. And sorry, I meant the current net income is 129 million, and the 6 years compounded 20% earnings growth is going to be at around 385 million. Now, with the 20 price to earnings ratio as an industry average, the expected net income, or the valuation, is 7.7 market capitalization, or 7.7 billion market capitalization. So I guess we could round that up to around 8 billion. So the price target is anywhere from 2,200% to 2,900%. So basically anywhere from around $100 to around $150 per share is the projected value over the course of around 5 to 7 years. The growth is excellent. The past year has been 40%, but analysts anticipate 20% long-term growth. That's the number I plugged in. $100 to $150 per share is a very good price over the course of many years. That's a lot of appreciation, a lot of money being made. Now, just today, the price of the stock has gone up by around 3%, but again, if you're into China for the long term, I think this valuation is very reasonable. It's in the medical sector. Medical tends to grow, and also it tends to be consistent, steady growth. And not only that, the emerging class can afford more expensive treatment, therefore meaning companies like Concord Medical will benefit from having the world's fastest growing middle class, or emerging middle class, and also this emerging middle class is gonna eventually get higher wages, more consumable income, more disposable wealth, therefore putting Concord Medical in the exact position we want them to be. Alright, that is it for me for today. Concord Medical, one of my favorite Chinese tech picks, not tech, but one of my favorite Chinese picks in general. And yeah, and I think that does it for me for today. Remember, the ticker symbol is CCM. Alright, take care folks, and I'll see you guys next time. But before I close the video, if you guys are interested in the charting software I use, check out the link right below this video, and if you're interested in my videos, be sure to subscribe because I'll have more content for you in the weeks and months ahead.